So now we are recording the event, and I'll be able to put that on a website. I need someone to stand right here by me and remind me to do that every time. So property coverage, those are our property coverage. Here's some visual examples, right? If we have a flood event, and flood events can be from rain, it can be from river overflow, it can be from your irrigation system causing a problem. Our electronic data, I think that's self-explanatory. Ordinance law, the code. So I was looking for some pictures and unable to find one, but on Redwood Road in West Jordan, probably just south of City Hall a little bit on the east side of Redwood Road, there was a old condo building, and it had 9 units. It was supposed to have 8 units, and the 9th unit was supposed to be a laundry room, but somewhere along the way they decided to not have the laundry room, and they converted it to a unit. Well, that building had a major fire, and when they went to rebuild, the code would only let them build 8 units, not 9. And so because they had ordinance law coverage insurance, that owner who didn't get their unit rebuilt was able to be compensated. It also works for just change over time in building code and requirements. Because remember, insurance is typically going to rebuild what was there and not do it differently unless you have that kind of a coverage. Our equipment, our boilers, our hot water boilers and our chillers and for our buildings. So we think, right, we always think about our commercial package, our property coverage for being in a townhome or condo type environment where we have multiple units and attached units. But don't forget that there are other things that we need to make sure that we're covering. And I'm going back, one of our participants got bumped. I'm going to get him back on the air with us here. Tyler, you should be unmuted when the time comes. So commercial package, we think of the buildings, but we've had some incidents over the years where in single-family homes in our PUD subdivisions where there should have been insurance and there hasn't been insurance. And we always, unfortunately, these are management change trigger events, and we find out and get new clients because of a lapse of insurance coverage. One example is a playground out in Tooele. An accelerant was put on the playground equipment, and then the playground was lit on fire. So this isn't a picture of that actual event, but if you Google it, lots of playgrounds have been set on fire all over the world. So this is an example of that, but this is in a single-family home subdivision. So they didn't have to provide coverage of the homes themselves. They just had to provide some liability, and they forgot that they had playground equipment. I've seen associations spend $150,000 really easy on playground equipment. So that's an insurable product. You need to remember to do that. We also had a high-end single-family subdivision up in the Dimpledale area, and just about $28 million homes, and an uninsured vehicle left the Dimpledale Drive and drove into their block wall. Now the house next to it was under construction, but we got a police report, we got the name and information, they were uninsured. However, the association, having no other common area, the only thing common was this block wall around the development, and they had not insured it. And since the motorist was uninsured, this ended up being about an $18,000 repair that they were unable to collect. That would have been a very minimal premium on an insurance policy. And don't forget that we have the things like furniture and pool tables, things that aren't attached, that are also property that belongs to the association. So we're not just insuring the building in these package policies. We want to be able to insure the association's own contents. All right, so how do we find out what are our insurance requirements? Once again, we're going to look at state statutes and regulations. In Utah, I think we're blessed to have a really nice statute. I get a lot of questions about it as I teach around the country. And Lamond and Tyler both will talk about our unique Utah statute. We want to make sure we're looking in the governing documents, because it's going to tell us in a whole insurance section what kind of insurance to have, and two, we need to go in there and we're going to identify what the common areas are. If that community up in Dimpledale would have read their documents, they would have seen that the block wall's common area, and they should have thought to insure that, or the playground out in Tooele. Our local and federal laws, the secondary mortgage market has a lot of restrictions or a lot of requirements, but unfortunately most of those requirements are condominium-based, and then they're multifamily attached product-based, and there aren't a lot of secondary mortgage market requirements for the PUD that just has a park or a wall. Contractual obligations, and then just using the good business judgment, which we talk about using all the time as board members. And how, once again, I'm going to go over this every time we talk insurance. When we're evaluating agents and brokers, we look at their experience. Are they specialists in the community association field? And understand our unique part of the real estate market. What's their claims processing history? Are they members of CAI? Are they members of IREM? Are they members of the trade groups that represent the insurance industry? What is their professional standing with the state? Their licenses? What kind of bonding, errors and omissions do they have? And that certified, the CIRM, Certified Insurance and Risk Management Specialist, that is a unique designation through the Community Association Institutes. And there's thousands of insurance agents. There's literally a handful of people in Utah that have the CIRM's designation. And I don't think, Lamont, you might want to open an Idaho office. I don't remember seeing in Idaho any, so that might be something you want to look at. So here's today's presenters. I'm going to tell you a little bit about each of them, and then we'll go through the program. We're very pleased to have Brian Cohen with us today, who currently serves as founder and CEO of Arden Insurance Services, specialty MGA serving the community association market. Arden distributes its insurance products through a select group of independent brokers in 8 western states. Brian formerly served as president and CEO and a member of the board of directors of Pacific Specialty Insurance Company, and before then worked for global software company Clear Technology. He began his insurance career at Farmers Insurance Group, and so we forgive him, and his additional duty at Farmers included chairing the budget committee, strategy committee, and investment committee. He was formerly a CPA and a corporate lawyer. So he earned his business degree from Cal Berkeley and his law degree from USC. Two fine academic institutions. Their athletic programs both need a lot of work. So Tyler Lamar is one of our founders and partners at Miller Harrison. He handles HOA matters, construction defect litigation, FHA certifications, governing document drafting and amendments, rule enforcement, collections, real estate development, etc., etc. He was recognized as one of Utah's legal elite in 2017 and 18. He has taught continuing legal education courses to the Utah Bar Construction Law Section, the Seminar Group, and the Utah Home Builders Association. He's a member of the committee organizing continuing legal ed for the real property section of the bar. He's also been a member of an attorney panel, presented at several Utah chapter CAI events, went to BYU Law School, and received his bachelor's from Colorado State and BYU. He is married and enjoys traveling, spending time outdoors, and eating great food. Who doesn't, right, Lamond? Or right, Tyler? And then Lamond Woods has 25 plus years of experience as an insurance provider and risk transfer specialist, senior partner at Century West Insurance, specializing in risk management for community associations, has received the CERMS designation as past board member of CAI and past chairperson of the Legislative Action Committee. And as a member of that committee, Lamond worked directly with the drafters and legislators on the language for SB 167, which became law in 2011 and is our community association law statutes that we follow. Lamond always seeks out and implements innovative ideas to be efficient and economical, and he is, despite working in the industry, Lamond did not learn his lesson, and he is a board member at his resort condominium community in Park City, Utah. So, gentlemen, thank you very much each for joining us today, and we're going to switch over, and I'm going to Brian's going to pop up on the screen in just a second. And Brian, we're glad you could join us today from California. Thank you very much for your time. Tell us a little bit, how's the insurance industry doing currently, and what can we expect in the future?
Thanks, Michael, and really happy to be here. And so I think the best way to describe what's going on in the insurance industry is something you're all aware of, which is, I think in January, if we looked out into the world, things were fine. Unfortunately, today there's a lot more risk in the world. And so as a result of that, insurance companies down the road, they're getting much more concerned about assuming risk, which is their business. They assume risk in the case of community associations. They assume, for today, the property risk associated with a community association. So as a result, what we're seeing today is, because of this environment of a riskier world, certain insurance companies are deciding, you know what, we're not going to issue as much insurance as we have in the past. So they're limiting their capacity. They're limiting the amount of money they want to put in to the insurance industry. Other things that are going on is they're saying, no, we'll still put the same amount of capital in, but we're going to limit, or we're going to narrow the coverages. So maybe in the past, we were much more comfortable giving very broad coverages. Today, what they're saying is, no, I think if you want broad coverages, it's going to cost you more. And that's really the last point, which is what we're also seeing happening is insurance carriers are saying, you know what, it's more expensive to take on risk today, so we're going to start to charge more for that risk. And so we're in a period right now of transition, and especially in Utah. Utah is a wonderful state for insurance companies to do business in. You have an excellent legal framework. With respect to community associations, you have specific frameworks, and that, again, creates predictability, which insurance companies like. Unfortunately, a lot of things are happening outside of your control, and so, again, it goes back to my earlier comment. So as a result, what I think you're going to start to see in this transition period is, as your association's insurance comes up for renewal, you're going to talk to your broker and you're going to find out either that previous coverages that you used to have might not be available, or if they are available, they're available at a higher price. And so that's the kind of situation that I see going on right now. And because of that, a couple of other points that I'll make. You have to have a good advisor. You have to be with a management firm that actually understands insurance, and then you have to use an insurance professional that understands how to go out and find the best coverage at the best price. And that isn't always easy, especially in insurance. Michael, at the beginning, you showed all the terms that are just used in property insurance. And I remember when I first started in the industry, looking at that term sheet gave me a headache. Actually, it still does today. And so imagine when you add on all the other layers of insurance you need, it can be very complicated. And so nobody wants to spend hours and hours and hours trying to figure that all out. You want to find someone that can address that with you. So that's how I see things sort of transitioning. And I will also mention another issue that we're seeing run through the insurance industry. And it does have a little impact on property coverage, although you'll see it more on the liability side. And it's this comment on what I would call social inflation. And what that is if people sue you, so in other words, you have a unit owner and the situation that turns out the association is covered for occurs in the unit, you might have some litigation going on between a unit owner and the association. That social inflation, the awards that people are getting when they go to court is starting to go up. So that's also impacting the cost side. And then the last thing that I didn't mention that I really do is weather. We hear about how weather patterns are changing, and they seem to be getting more ferocious. And that as well is adding a lot of uncertainty into evaluating the insurable risk of an association. So these are all factors that are going on. I will end by this. I've given you sort of all the negatives. Here's the positive that I will tell you. The use of technology by insurance companies and data analytics. If you're a good association, if you regularly maintain and update your community, if you have good rules and regulations that you abide by, that's what insurers want. And their technology they use is becoming better at discerning the good associations from the bad associations. And the good associations will always pay less.
Very good. Very good. Very interesting. Yeah, we met with a company that is flying very low-level drones and planes, and they're actually it's the same folks who kind of put together the estimateware, right? And they fly over Xactimate, yeah. And they fly over everything and have very recent pictures, a high definition of roofs and of asphalt, and they know the condition communities were in before an insurable event. And so there's really no hiding anything anymore.
Agreed. And we actually use Xactimate, and we use it to actually evaluate the quality of the community, and it's actually better results than sending an individual inspector out to the actual community itself.
Very, very exciting, very exciting. Well, Brian will hang around for a little bit in case we have some Q&A or panel-type discussion, so thanks for that information. Lamont, do you want to kick off the Tyler and yours portion of the event?
Yeah, absolutely. Thank you. Will you bring up the slide of the building on fire?
Building on fire. All right. Give me just a second.
All right. So while he's bringing that up, it was alluded to, Michael alluded to language or the law that changed in 2011. That language, and I'm getting feedback. Are you hearing feedback, Michael?
No, we're hearing you normal.
Okay, perfect. So the legislation requires that there is blanket coverage. In this photo you see in 2008, there's a building on fire, right? So
this was very high resolution at the time.
So go to the next picture. So now we see that this building has no insurance. That section of the building couldn't be rebuilt. the building next to it could not get a certificate of occupancy. So the law that passed actually prevents this situation from happening again because it requires basically blanket coverage. Before the law changed, there was legislation that was very difficult in terms of knowing exactly how a claim would be settled. And we have a copy of that. I would argue that legislation, the way that law read at that time, was not completely different than what we have today, with the exception of now we know how the deductible is going to be passed to the unit owner. We know and understand what the responsibilities are for the association and what they're going to insure for. I want to give Tyler a minute to address the law and some of the further background for that. Tyler, are you ready?
Maybe not. Let me find you, Tyler. Let's see. There's Tyler. Okay, hang on, Tyler.
Perfect. Okay, can you hear me okay?
We can hear you now.
All right, if you will start with even the slide before this, it's worth looking at the statutory sections that apply. And I'm also hearing feedback. I wonder if the attendees are hearing that.
Not seeing. Let's see here. Looks like we are hearing some feedback. Hang on. Lamond and Tyler, will you jump off and jump back in?
Sure.
And we'll see if that corrects it really quick. Now the key is if I let them back in. Let's see here. Well, I see someone saying you can hear me fine, but as my neighbor who's about 90 years old said, my husband thinks you're the best Sunday school teacher he's ever had because you're the only one he's ever heard for about 30 years. So that might be just me being loudmouth, not my connection. All right, Tyler, I see you're back in. Are you back with us? Tyler? And Lamond, I see that you're back in.
Okay, I'm back. Can you hear me?
We can hear you, so hopefully that corrected some of the feedback issue. And up on the screen should be those statute now.
Okay, so if you are a condominium, the relevant code section that I'm going to discuss is depicted here on the right, 57-843. If you are not a non-condominium planned unit development, it is in the same title but a different subchapter, Part 8A and Part 4. So those are the reference points if you want to go actually dig into the statute and the cure for insomnia. But if you want to nerd out, there's the source. Okay, Michael, so if you go to the next slide. This graphic is intended to explain the complexities of the statute, once you get your head around it, it makes your life a lot easier, and it addresses the problems going on, just address a couple of those images. So what I've depicted here is 3 units that are stacked. So this would be a condominium, but the same principles apply to a townhome structure where you have units side by side if the insurance applies to you. And we'll talk in a moment about a scenario where the insurance statute does not apply to side-by-side townhomes. So I've intentionally included graphics of a few different components here of the building. We've got the building itself in blue. We've got a ceiling fan, a sofa, a seat, a gold-plated toilet, some cabinetry, and an oven and range. Everything in this picture, except for the sofa and the chair, would be covered by the blanket policy under Utah statute because they are fixtures that are permanently attached to the building. If you took the roof off this building and turned it upside down, those fixtures, the toilet, the cabinetry, the oven, the ceiling fan, would be part of the unit. They're attached to it, whereas the sofa and the chair would fall out. So assume now for a moment that we have a loss that originates from Unit 3. And I've got these little poo emojis here. It's a sewer leak. And it originates from 3. And if you click the next slide, oh, it's making its way down. It damages Unit 2 and some cabinetry, and it gets all the way down to Unit 1. So Unit 3, even though it's the source, is unscathed. Unit 2 is damaged in the cabinetry and in the walls, and Unit 1 is damaged in some appliances and in the flooring and in the exterior walls. Okay, now let's pull up the next animation. Assume that in this HOA that this leak created $20,000 of total damage to the building and all of the units. That's the aggregate damage that occurred. And that this HOA had a deductible of $10,000. Here's how that would be split out. First of all, we've determined through an adjuster and some investigation that $5,000, or 1/4 of the damage, was in the common area walls and joists and floors. Unit 3, again, was unscathed. They were the source of the problem. Let's say they even did it intentionally, but they have $0 worth of damage. Unit 2, they had $10,000 of damage inside of the unit to the cabinetry, and Unit 1 had $5,000 of unit damage to the appliances and their floor finishes. So if you hit the next animation, here's how the deductible would be split up. Because it's $10,000, the HOA has 1/4 of the damage attributable to its common area, so it would be responsible for $2,500 worth of the deductible. Unit 3, again, even though they're the source, they have no damage. You have to separate fault from the insurance deductible and the insurance analysis. Fault doesn't matter. They end up paying $0 for the deductible on this loss. Unit 2 has 50% of the total damage, so they contribute 50% of the deductible, $5,000 hit. And Unit 1 had 1/4 of the damage, so like the HOA, they chip in 25% of the deductible. Now, if you'll hit the next graphic, there may be other losses here. It may take some time for Units 2 and 1 to be back to habitable condition. So they may need a stay at the Marriott Hotel or a hotel. The HOA's policy would not cover this. This is something that the homeowners would look to their own HO6 policy or a specific policy that would help the homeowners with their portion of the deductible and their time out of their unit. And there also may be some lost income. Let's say Unit 1, they're getting a lot of people use their unit because of their gold-plated toilet through Airbnb or something like that, and now they're losing income because nobody can stay there and use this gold toilet. Well, they would look to their own policy as well, rather than the master policy to get this covered. Now, I put a gold-plated toilet in there intentionally. even though this owner has upgraded to a gold-plated toilet, the HOA's policy is nevertheless responsible to cover property damage because it is a fixture of the building. And the same goes for upgraded cabinetry and upgraded fixtures within the unit, permanent range or something like that above the oven. If the unit owner upgrades, the HOA is still responsible to be covering these upgraded components, gold floors, gold toilets, whatever it may be. Okay, now if you'll go to the next slide, this graphic makes a little different assumption. Let's look at the numbers in red up at top. If you are a pre-2012 HOA, you were created before 2012, regardless of who maintains the roofs, assume just for a second that the HOA even maintains the roofs and exteriors. And if the owners under your CC&Rs pre-2012 are required to insure their own dwellings, in Utah, you do not split the deductible and go through that analysis like we just explained. Instead, if there's a big rain event or ice damming or snow event that causes $40,000 of damage to Unit 1, Unit 1 is 100% responsible through their own insurance. No, nothing on the HOA, even though the HOA maintains the roofs. Same for 2. Let's say they have a little bit of less damage, 100% responsible. And 3 has a devastating loss. Under this scenario, they would also be 100% responsible. Now, my one word of caution here, if you are a pre-2012 HOA and your documents currently require your owners to insure their own dwelling, I would strongly consider an amendment to your CC&Rs to opt in to the new insurance provision. And if you don't do that, make sure you are clearly communicating to your owners their insurance obligations. We've come across 2 disaster scenarios in the last year where unit owners have assumed that their HOA is part of the new statute, so they're not buying the right insurance, and neither is the HOA, and we've had devastating losses with no coverage. We had one homeowner who's homeless living with a friend because there's not coverage on either side to pay for a significant loss that occurred in her unit. So it may be worth just amending your documents to opt in to the new statute for clarity. Most insurance professionals are expecting that today, that you will be like a post-2012 HOA or a pre-2012 HOA where the association maintains the dwelling. But be careful there, and it's worth taking a look at your documents and making sure you're meeting with an insurance professional so that everyone's got the right coverage for their unit. Michael, I can't hear you if you're talking to me. For some reason, I'm unable to hear you.
Well,
there
because
you
I
are.
muted myself.
There you are. Okay.
I muted myself because I was the feedback problem, apparently.
I see.
Lamond, are you with us?
Yep, I am here. Thank you.
Why don't you jump in and tell us that I was just saying silently that all insurance is the same, isn't it?
Hardly. It hardly is the same. And we'll talk about that. I want to talk about a couple things that Tyler hit on there. Within the law, it stipulates about what the property insurance shall include. So I'm going to read that. And the description Tyler used, turn the place upside down, everything that's still attached, right, is the association's responsibility to insure. So the law reads, property insurance shall include coverage for any fixture, improvement, betterment installed at any time to a unit or limited common area, whether installed in the original construction or in a later remodel. And then it goes into a list, including floor coverings, cabinets, light fixtures, electrical fixtures, plumbing fixtures, paint, wall coverings, windows, and then there's a caveat that says, and any other item permanently a part of or fixed to the unit. So again, Tyler used the golden toilet, right? If there is a unit owner that has such a device, we know of a Park City unit who has like a $300,000 fireplace mantle. It would be the association insurance responsibility to replace that mantle. So it puts a lot of burden on the master policy. We are seeing higher deductibles, and I continue to encourage those higher deductibles. There is a bit of a catch on that. Know that the association must keep in the bank or earmarked in their financials an amount equal to the property deductible or $10,000, whichever is less. So if the association has a $5,000 deductible, they need $5,000. If it's $10,000, they need to have earmarked $10,000. They could have a $50,000 deductible, and I have a few communities like that. They actually do not have to have more than the $10,000 according to the legislation. Although it would be a good idea for those associations that have high deductibles to be able to afford to pay for it. What else? Another important thing about the law is that the unit owner must be given notice about what that deductible is. And any change of the deductible must also be mentioned or be notified. The law does not say that you have to give 30 days. It doesn't specify how that notice is given. If your association has the ability to put information on its website, and that's okay within the CC&Rs to do so, then that would constitute notice for that. But again, anytime you're changing that deductible, I encourage a couple weeks or even longer for unit owners to get with their own insurance. Giving them notice of just the deductible is now $25,000 is going to suffice. Perfect. And Michael has on here the legislation, and we could go through that, but let's get to the fun stuff with insurance. Michael, will you pull up the slide for single-family homes? So, what I'm referring to here is a PUD community that does not insure the structures. They do not insure the structures. So, unattached community. Within this, you can still have property insurance. Michael alluded to a couple situations, one with the playground that was inadequately insured, and the other was with a fence that was not insured. So those are items that ought to be insured under the property insurance for a single-family home. What you're looking at on this slide is a bid we recently gave. You'll notice that the property in this case constitutes fences, monuments, structures, and the playgrounds, plural, and the amount of coverage. So this item is really the most important in terms of property coverage for a single-family community. Rather than go into all of these other details within this, Michael, I'd like to go to the townhomes that has a similar list, and we'll talk about coverages. So the law requires that there be a blanket property policy. Well, what is a blanket? Well, the opposite of that is a schedule of property wherein each building is scheduled on the policy. And in those cases, oftentimes you're only going to have an amount of insurance for that building that it shows in the declaration page. So an example would be you have 10 buildings that are all valued at $1 million apiece. On a schedule, again, that's not what we want. On a schedule, you're going to be limited to $1 million for each building, whereas a blanket is going to consolidate all of those values together and allow you to use it wherever you need it. So number one, you want to have blanket coverage. The law specifies that you have blanket or you have guaranteed replacement cost. I would say it's best to have both, but you must have The law says you must be insured to 100% of the replacement cost, and that you must have guaranteed or blanket coverage. So it does allow some flexibility depending on your carriers. In this option 3, there's a red highlight that shows there's no property coverage. Well, we skirt that rule by having guaranteed replacement cost coverage, which you can see a couple down from that. Another item, just going down the list, business personal property. What is business personal property? Michael alluded to this. It's those things in your clubhouse that shake out when you turn the place upside down. It could be pool tables. It could be furnishings, things of that nature, something that you can pick up and haul out the front door. There's typically not a lot of that coverage. If you have a clubhouse, if you have a weight room, then that dollar amount could actually be higher. Replacement cost coverage is just that. It's providing new for old. So your roofs are, let's say they're 10 years old and they've depreciated by maybe 5% over those 10 years. Maybe it's greater than that. With replacement cost, they're going to give you a new roof, whereas if you had actual cash value coverage, they're going to depreciate or subtract that 5% or 10% depreciation. So you want to have that coverage. Guaranteed replacement cost is simply that. Let's say you're insured for, in this case, option 1 has $25,117,000 of coverage. Well, let's say that there was a catastrophic event, let's say a tornado destroyed the community, and the construction costs jumped up overnight, and now it's going to cost $28 million to rebuild. With option 1, or that what it says current, where it's the $25,007,000, you're only going to get that amount of coverage, whereas guaranteed replacement is going to give you an amount greater than the amount that you have insured. Going on, agreed value or co-insurance waived. Co-insurance is also something that you want to avoid. The law doesn't say anything about this. There are certainly policies with co-insurance. But that co-insurance clause stipulates that you must have up to 80 or 90%, depending on the clause, or 100% of what the replacement value is. So the lower the number, the more cushion you have. So if you have an 80% co-insurance, then the insurance contract requires that you just have at least 80% of the amount of insurance that you should have for replacement. Again, we try to always make sure that we get co-insurance waived, and the other item is agreed value. So those are almost synonymous. So in these examples, all of the options have co-insurance waived. Michael also alluded to ordinance and law coverage, wherein a community was unable to rebuild one of their units. This is especially important for older communities where the laws have changed concerning construction. Maybe in Park City, it wasn't required to have a sprinkler system when a building was built, but with upgrades or code changes, they're now imposing that you have a residential sprinkler system. If you did not have a sprinkler system before, insurance isn't going to give you one as part of the claim unless you have this ordinance and law coverage. And that is under that Part B, increased cost of construction. Sewer and drain backup coverage. I don't believe Michael alluded to this one, but he has an example of a community that suffered a very large loss as a result of a backup of sewer and drain. So this isn't just on site. This happened off site, out of the building, and backed up into multiple units and required, I believe it was over $100,000 of damage that was done in Michael's association. You can see here that coverage is limited by current to $75,000. Option 1 has unlimited coverage. That's certainly what you would hope for, but it isn't available by all companies. Option 2 has a $100,000 limit, and option 3 is at 50. You may think that as your broker that I can change those, and to a degree, some insurance companies will allow other limits, but some are limited to. In the case of option 3, it's a max of $50,000 is what you can get. Equipment breakdown is a coverage that we don't see used very often, but if you are in any sort of a high-rise, that could be a critical coverage. Equipment breakdown is not necessarily insurance. It is something breaks down. One claim example is a high-rise that we insured where the AC unit went out. Trying to remember if something in the compressor, I believe, and they had to truck that part. It was substantial from back east, and it was a very, very large claim. And that's where we got coverage, is under the equipment breakdown. Again, property deductibles, as I've mentioned, are trending higher. I think that's a good thing. Unit owners can buy insurance through their HO6 policy for a very, very reasonable cost. Even $50,000 is not unreasonable. We've looked often at what the cost is for an HO6 for them to go from a $10,000 amount on their policy to $25,000, and it's very rare that cost exceeds $20 per year. So you're not burdening the unit owners by having a higher deductible. Their deductible stays the same. It'll be a $500 deductible, a $1,000 deductible, and then their insurance bridges that gap between their deductible and what the master policy deductible is, whether it's 10, 5, 10, 25, and so on. Michael, that's the highlights of property coverage, and I see we're about at 1 o'clock. So what else would you like us to cover?
There we go. I think one of the most common questions, and board members, if you have any questions, feel free to type it in the chat, or we'll open up the Q&A here for just a second. But people are always concerned, Lamond, on what that building coverage amount is, that they don't seem to know how the insurance company comes to that total building coverage amount. And they might get bids from a couple different places, and it's even a little bit different. Should board members be super concerned with the amount of building coverage that the insurance company is saying they need?
Yes, and they should be concerned. The law requires 100% replacement cost. If you have guaranteed replacement costs, then you have the ultimate safety net. So it's not as big of a deal. But otherwise, yeah, they should be looking at that very closely. Oftentimes, reconstruction cost is much more expensive than new construction. So keep that in mind. Market value is not a good indicator of what the replacement cost is. It was alluded to, Brian and Michael, you alluded to this service called Xactimate, where, and that's a tool that the insurance companies use to determine what the replacement cost is on a building.
Okay, very good. I'm going to just open it up real quick, see if anyone has a question, and then we'll wrap it up. So just a moment. If you have a question, just hit the Q&A button, and your audio will turn on, and you can ask that question. One thing, let's see if anyone comes in. Tyler, what as we work on the LAC, and our law's now almost a decade old, what kind of tweaks would do you think that our statute might need, that we might need to be considering?
I'll jump in. Can you hear me okay, Michael?
Yeah, we can hear you.
One of the questions we commonly hear is, are we required to provide earthquake coverage? And I'm getting feedback again, so maybe I'm coming through yours. And as we've analyzed that, we look at the statute, and there's a provision in there that says what's customarily provided or what ordinarily is provided, which causes us to reach out to professionals like Lamond and Brian and others and say, what percentage of Utah HOAs are obtaining earthquake coverage? And then we have to do this judgment call as to, is that, if it's a quarter of the association, is that ordinarily provided? And we have people, so it might help to clarify which coverages are optional, and it might, to give some direction to unit owners and HOAs as to who should be obtaining those coverages. There's a lot of confusion by unit owners, too, as to whether they're able to obtain earthquake coverage for their unit when their HOA doesn't, and Lamont may be able to speak to that. But
there is a few policies that will insure for the full replacement value of a townhome or condominium. They're rare. We represent a product, but there's probably 100 other agents in the state who have the same product. But it is unique, but you're always going to have the Lloyd's of London type markets who are also going to be able to accommodate. So yes, it is possible, but it's not widely available. It's possible to get the coverage, but not widely available. Michael, are you there?
Michael, you're muted.
Tyler, can you still hear me?
All right. Brian, just give us a last minute of advice for our board members going in the insurance, thinking about insurance. What would you say is your top thing you want them to remember going home today?
The top thing I want them to remember is insurance companies want the best risks. If you do all the preventative maintenance and risk management that a well-maintained property will do, an association will do, you will pay less for insurance than those that don't.
Great advice. Thank you very much, Brian and Tyler and Lamond and board members who've attended today. We appreciate you. Continue staying safe. Continue wearing your mask. We'll get this virus beat. We look forward to meeting again in person someday and feeding everybody. Otherwise, thank you for attending, and we'll see you next month.